Market Shots are short video segments designed to help you develop a trading strategy that you can stick with. Here to help you is the Chief Market Strategist for the Market Guys, A.J. Monty.
Hello investors and traders, and welcome to yet another Market Shot educational video, with this one being the rubber band effect. This is something most investors and traders have never heard of until now. This is a very reliable strategy that you could put in place by using simple charts. Now this is a chart of Broadcom Corp, ticker symbol BRCM. And if you look in the top left-hand corner, this is a 3-year weekly chart. So the blue line here that represents a 20-period moving average, the period for this chart is in weeks. So this is a 20-week moving average. Now again, going back to these times back here this is November and December of 2010 coming into 2011, you can see that the stock moved quite far above the 20-period moving average. Now, here's where the rubber band effect takes place. You have to use your imagination here, but imagine you have a rubber band and you connect one end of the rubber band to this blue moving average line and the other end of the rubber band to the price of the stock. Now what's happening is, as the stock moves above this average, the rubber band is getting stretched. The further it moves from the moving average, the more likely that the stock will move back towards the moving average. Now look what happens on the way down. When the stock drops, the rubber band gets stretched again. From here to here, you can imagine that rubber band again, and what happens? The stock gradually moves back towards the moving average. Now this works best in stocks that have been in trading channels. What's a trading channel? That's a stock here that has an area of resistance that's fairly consistent, followed by an area of support. You're going to connect as many of those dots as you can, and this whole area, this trading range, is often referred to the trading channel. Now watch what happens when I change this to a daily chart. I'm just going to switch the interval to daily. Then I'm going to remove these lines here so it'll give you a clear view of what the price action is doing. And you can see here now the rubber band is being stretched in a more dramatic way. Again, this is a daily chart, and the moving average now represents 20 days because we're set at daily intervals. Now look at this rubber band now. It's being stretched dramatically. Not only that, but in an 8-day period, as we're doing this recording, this stock has gapped down 3 times. There's a minor gap right there. There's a minor gap right there. And then most recently there's a longer gap where the stock just fell out of bed and went right down. Now this is an opportunity for traders because, again, if I zoom in, continue to zoom in there, this stock has dropped dramatically, and you can see the volume increasing, which signals an excited selling community. But what's happened over the past couple of days now, yesterday we have a hammer pattern. Go back to the Market Shot video that talks about hammers and you'll see why that's bullish. And you see the volume dropping. Now here's the significance of the volume being at lower levels. When a stock is going down and the volume is going up, it means the sellers are excited. When the volume starts to drop, it tells us that the sellers are exhausted. They're now lightening up on that selling pressure, and now that there's a bullish pattern here in that hammer that I mentioned, the buyers will start to move in. So again, this is an opportunity for us to buy the stock at this area, and then as it goes back up to fill a gap or move back to the moving average, this whole area right here becomes our profit target area. And for this stock, a $3 move or even a $4 move on that stock is a significant percentage that we would expect to have happen within a couple of weeks. So that is the strategy behind the rubber band effect. I hope you use it. And before I let you go, I'd like to give you an assignment. That's something we like to do with the Market Shot videos, is give you a lesson plan that you can follow. Go back and select just 5 stocks. We don't have to go crazy with 10 or 15, or unless you want to, of course. But go back and try to find 5 stocks that have been in trading channels like we described here in Broadcom. and then measure with your eye the distance that the stock price travels away from the moving average, and look at how often it'll snap back to that moving average. You'll see that 80% of the time it'll snap back and give you an opportunity to trade that stock. Now, once you're able to identify the rubber band effect and how stocks move away from that moving average, you then look for some of the other buy signals, like we see here in the hammer, or it could be a bullish engulfing pattern, it could be a bearish engulfing pattern, whatever it may be. You start to apply those signals to your trading strategy, and then, most importantly, you use the 1% rule for managing risk. That video is also on our video page with the market shots. Please make sure you understand and even memorize the 1% rule, so that should this stock not move in the direction we expect it to, you could manage that risk and limit that risk to 1% of your total account. So I want to thank you for joining us, and I look forward to the next video.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.